Hey everyone, welcome back to Corporate Decoder, the place where we decode the secrets of big business. And let me tell you, this latest report from Miluna Acquisition Corp is a spicy one. Almost like finding out the pizza place accidentally gave you extra pepperoni for free. Before we dive in, if you dug this kind of straight talk analysis of financial documents, make sure you are subscribed and hit that notification bell. Also, join our awesome Discord community linked down in the description where we break down even more. So we're looking at a 10K filing, basically a yearly checkup for a company. Miluna Acquisition Corp, or MMTX as you might see it, is a company that is basically been set up to buy another company. Think of them as a matchmaker for businesses. They had their big official start, what they call an initial public offering, or IPO, back in October. And what did they offer? Well, they sold units. Each unit was like a package deal. Inside you got one regular share of the company, which they call an ordinary share, and one warrant. A warrant is basically a coupon that lets you buy a share later at a set price. In this case, each warrant was good to buy one ordinary share for $11.5. They sold these units for $10 each. The ordinary shares themselves are pretty much worthless on paper in terms of stated value, like a tiny fraction of a cent per share. It is the potential of the company behind those shares that gives them value. And those warrants, they're important. They give people the right to buy more shares, which can be a good thing if the company does well and the share price goes up above that $11.5 exercise price. This filing tells us that Miluna Acquisition Corp, the company we're looking at, had its initial public offering not too long ago. They sold a bunch of these units, specifically 6 million units, raking in $60 million. Interestingly, this company is registered in the Cayman Islands, a place often chosen for its favorable business and tax laws, though its principal executive offices are in Taipei, Taiwan. All of their registered securities, these units, ordinary shares, and warrants are traded on the Nasdaq stock market. That is a big, well-known stock exchange. They are filing with the US Securities and Exchange Commission, or SEC, which is like the watchdog for the stock market in America. They've also checked a box saying they are an emerging growth company. This means they are a newer company and get some benefits like a bit more flexibility with how they report their finances for a while. Now, let's get to the meat of it. This report talks about how the IPO went and what happened right after. They had their IPO on the 24th of October. Then, within days, the folks who helped them sell these shares, the underwriters, decided to exercise their over-allotment option. Basically, the underwriters thought they could sell even more shares than initially planned, so they bought an extra 900,000 units. This happened on the 28th of October, bringing in another $9 million. So from the IPO and these extra units, they raised quite a bit of money. A significant chunk, over $69 million from the IPO, the option units, and some private placements all went into a special trust account. This is super common for these types of acquisition companies. They hold this money until they find a real operating business to buy and merge with. They've already provided a snapshot of their finances right after the IPO. And now, they're giving us an updated picture with their unaudited pro forma balance sheet as of the 28th of October, which includes that extra money from the over-allotment option. This part just tells us what extra documents are included with this report. The main exhibit here is that unaudited pro forma balance sheet. This is important because it shows us the company's financial shape after all these fundraising activities. It's a snapshot of what they own and what they owe at that specific moment in time. And finally, the signature page. This is where the top boss, the chief executive officer, in this case, officially signs off, confirming that everything in the report is true and accurate to the best of their knowledge. Now, let's talk about the real story here. Miluna Acquisition Corp is what is known as a SPAC, a special purpose acquisition company. Their whole business model is to go public, raise a pile of cash like they just did, and then use that money to buy a private company, taking it public in the process. It is a shortcut to the stock market for businesses that might not want to go through the traditional IPO process. The key figures here are the amounts raised. They pulled in a total of $60 million from the initial IPO, plus another $9 million from the underwriters exercising their option, and then some additional funds from private placements. This all adds up to a significant war chest held in that trust account. This isn't money they have to spend on operations yet. It is earmarked for a future acquisition. The balance sheet they've provided, even though it is unaudited, gives us a look at their assets, which are mostly cash in that trust account, and their liabilities, which are likely minimal at this stage. What is critical for investors to watch is what company they eventually decide to buy. That acquisition, or de-SPAC transaction as it is called, is where the real potential for value creation or destruction lies. The risks here are inherent to the SPAC model. There is the risk that they can't find a suitable company to acquire within the time frame they have SPACs. typically have about 2 years. If they don't find a target, the money in the trust account is usually returned to shareholders. There is also the risk that they buy a company, but that company doesn't perform as expected after becoming public. What is interesting is that they have a clear structure for their shares and warrants, and they've successfully raised significant capital. Their direction is very clear: find and merge with an operating business. The strength is in their ability to raise funds. A weakness, or rather a significant risk, is the uncertainty of the acquisition target and its future performance. In my opinion, Miluna Accession Corp is in the early stages of its journey. They've executed the fundraising part well. The real test will be in their ability to identify and successfully merge with a promising company. Investors should be looking at the management team's track record in identifying good acquisition targets and the strategic fit of any potential merger. The cash in the trust is a good start, but it is the future business they acquire that will determine their ultimate success. Alright, that is our breakdown of Miluna Accession Corp's latest filing. What is your take on SPACs and this company's approach? Drop your thoughts in the comments if this analysis was valuable. Hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.